Student loan debt has become a major financial burden for many people in the United States. According to the Federal Reserve, outstanding student loan debt in the country has surpassed $1.7 trillion, with over 45 million borrowers carrying an average debt load of around $38,000. For many individuals, paying off this debt can be a daunting and overwhelming task. However, there are several strategies that can be employed to help get rid of student loans. First and foremost, it is important to understand the different types of student loans and the options for repayment. There are two main types of student loans, federal and private. Federal loans are issued by the government, while private loans are issued by banks and other financial institutions. Federal loans typically offer more flexible repayment terms and lower interest rates than private loans. One option for repaying federal student loans is through an income-driven repayment plan. These plans allow borrowers to make payments based on their income, with the possibility of forgiveness after a certain period of time. There are several different income-driven repayment plans available, including income-based repayment, IBR, pay-as-you-earn, PAYE, and revised pay-as-you-earn repay. These plans can help make student loan payments more manageable, especially for those with low incomes or high debt loads. Another option for repaying federal student loans is through Public Service Loan Forgiveness, PSLF. This program allows borrowers who work in certain public service jobs to have their loans forgiven after 10 years of qualifying payments. Qualifying jobs include those in government, nonprofit organizations, and public education. For private student loans, the options for repayment may be more limited. However, it may still be possible to negotiate with the lender for a more favorable repayment plan or interest rate. Some lenders may also offer loan consolidation or refinancing options, which can help reduce monthly payments or overall interest costs. In addition to these repayment options, there are several other strategies that can be employed to get rid of student loans. One such strategy is to increase income through additional education or training. This can help individuals qualify for higher paying jobs and make it easier to pay off student loan debt. Another strategy is to reduce expenses and live frugally. This may involve making sacrifices in the short term, such as avoiding unnecessary purchases or living with roommates, but can help free up more money for student loan payments. Finally, it may be possible to take advantage of employer-sponsored student loan repayment programs. Some companies offer these programs as a way to attract and retain talented employees. These programs typically involve the employer making payments directly to the employee's student loan lender, reducing the employee's overall debt load. In addition to income-driven repayment plans, there are other options available for borrowers looking to manage their student loan debt. One such option is loan consolidation, which involves combining multiple federal loans into a single loan with a fixed interest rate. This can simplify the repayment process by reducing the number of monthly payments required, and may also result in a lower monthly payment if the borrower qualifies for a longer repayment term. Another option is loan refinancing, which involves taking out a new loan to pay off the existing student loans. This can be done with either federal or private loans, and may result in a lower interest rate if the borrower has good credit or a cosigner with good credit. Refinancing can also simplify the repayment process by consolidating multiple loans into a single payment, and may help reduce overall interest cost over the life of the loan. It is important to note that loan consolidation and refinancing are not the same thing. Consolidation involves combining multiple loans into a single loan, while refinancing involves taking out a new loan to pay off the existing loans. Borrowers should carefully consider the pros and cons of each option before making a decision. When considering loan consolidation or refinancing, it is important to research different lenders and compare their terms and interest rates. Some lenders may offer better rates or more flexible repayment options than others, so it is important to shop around and find the best option for your individual needs. It is also important to keep in mind that loan consolidation and refinancing may not be available for all types of student loans. For example, private student loans may not be eligible for federal loan consolidation, and may have different options and requirements for refinancing. Borrowers should carefully review the terms and conditions of their loans and consult with a financial advisor or loan servicer to determine the best course of action. Overall, loan consolidation and refinancing can be effective tools for managing student loan debt, but they are not a one-size-fits-all solution. Borrowers should carefully consider their individual financial situation and goals, and explore all available options before making a decision. There are ways to reduce the loan term and pay less interest on student loans. One way is to make extra payments towards the loan principal. This can help to reduce the overall balance of the loan, which can result in a shorter repayment term and less interest paid over the life of the loan. Another option is to refinance the loan with a shorter repayment term. This can help to reduce the amount of interest paid over the life of the loan, as well as shorten the repayment term. However, it is important to note that refinancing may result in higher monthly payments, so borrowers should carefully consider their financial situation before deciding to refinance. Refinancing student loans with a shorter repayment term can be a smart move for those looking to reduce the amount of interest they pay over the life of the loan. When refinancing, borrowers take out a new loan with a private lender to pay off their existing loans. The new loan often comes with a lower interest rate, which can save borrowers money on interest charges. However, it's important to keep in mind that refinancing can also result in higher monthly payments. This is because the loan term is typically shorter, meaning borrowers have less time to repay the loan balance. As a result, the monthly payments may be higher than what the borrower was paying before. Before deciding to refinance, borrowers should carefully consider their financial situation and ensure they can afford the new monthly payments. This may require creating a budget and analyzing income and expenses to determine what monthly payment is feasible. Additionally, some borrowers may be eligible for loan forgiveness programs, which can help to reduce the total amount owed on their student loans. For example, Public Service Loan Forgiveness, PSLF, is a program that forgives the remaining balance on federal direct loans after the borrower has made 120 qualifying monthly payments while working full-time for a qualifying employer. It is important to note that not all borrowers will qualify for loan forgiveness programs, and that eligibility requirements and application processes can vary depending on the program. Borrowers should carefully research their options and consult with a financial advisor or loan servicer to determine the best course of action for their individual situation. Getting rid of student loan debt can be a difficult and challenging task, but it is not impossible. By understanding the different types of loans and repayment options, as well as employing strategies to increase income and reduce expenses, individuals can take control of their student loan debt and work towards a more financially secure future. This is for educational purposes only and should not be taken as financial advice. The information provided is not intended to be a substitute for professional financial advice. Please consult a financial professional before making any financial decisions. Please, comment, like and subscribe.